G'day traders, today we're going to talk about the best Forex trading strategy for trading volatile markets. Stay tuned, you don't want to miss this. G'day traders, Stacy Burke from Stacy Burke Trading. It's Friday. We've had a massive week in the markets. The global share markets are in free fall basically. The currency markets have been fantastic in terms of their volatility. As traders, if we don't have volatility, it's very hard to make money. So while the rest of the world's markets are scrambling and people who are tied into the share markets are in fear and in shock and getting emotional and distraught, and we have the coronavirus to deal with, if you're trading intraday on the currency markets, one of the biggest things I like to do at night is sleep with peace of mind. Being Friday, I recommend, especially today, to not be exposed over the weekend in the markets, in the currency markets. As you know, if you've been following this long enough, especially on the pound crosses, we can get gaps of over 100 pips on a Monday morning, possibly against the current position that you may go into the weekend with. So I never go into the weekend with any open positions. Very, very rarely, if ever, in normal market conditions, if I was in a 2-week move or something like that, it's a little bit different, but generally speaking, as a rule of thumb, I don't hold positions over the weekend for that very reason. That's an easy way for institutions, the banks, whatever we call them, the smart money, to get free money from us just by gapping the market and clearing out orders, even just with the spreads. That clears out orders above and below the last bracket of price action that's occurred into the close of the market. So if you start looking at it from the other side of the table, that's an easy way for them to get free money that's completely justified because world events cause opening prices to gap from where they closed on a Friday night. So today we're going to talk about what I think is the best Forex trading strategy for trading volatile markets. The markets this week have been massive. We've had 100, 200, 300 pip moves. We've had just constant movement from high to low. We've had some trends. We've had probably some of the best conditions as currency traders for a long time. I consider this right now to be the perfect storm of opportunity for those traders who are patient and disciplined and who have developed their skill set to patiently wait for the price and opportunities to come along at the highs and lows to position themselves, as in this morning on the pound yen, towards the close of the evening session in New York. A couple hours out, we had a 1, 2, 3 setup on the 1-minute chart at the high at double zeros that moved down 150 pips within 1 hour. That's the kind of opportunities that are existing right now for traders. On the 15-minute charts, we've had 200 pip moves. So again, we're going to go and just go over some things about live time trading. The markets will set up during the Asian hours, even when there's movement. The movement could be 100 pips, but they will paint a high and a low. And then if you step back, we've had days this week where they'll go into the range and make inside highs and lows. Those are areas where traders can often get trapped in the middle of a box. Now they may offer trades and they may offer 50 pip movements, but it also sometimes can become a 50-50 opportunity in that the movement that they generate traps traders into the middle of those highs and lows before it breaks out to one side or the other. And so doing so, it can keep you into a choppy environment until they make their move. So I often will wait until there's a strong burst of price action to go outside of that high and low. I'm talking about an inter high and low, outside of or inside of a higher high and a lower low. And one of the reasons that is because when we get into the equity opening times, one of the reasons I don't like to trade in Asia is that inevitably both of those highs and lows will get stop hunted. So once they paint a bigger box, a bigger high and low, or they take out one of the extremes heading into the Europe Open or the London Open, we'll look for the engulfments or pin hammers, reversals at the tops or bottoms that again we can position ourselves inside, most likely, a double zero or a 50-50 double zero box at numbers with a price pattern where we can target maybe 100, 150 pips of movement with a 1-bar stop. So right now volatility is a bit higher, so obviously our stop losses where they would maybe normally be 20-25 pips, some of these may be 30 and 35 pips. In that particular case, the trade thesis doesn't change, but you may need to adjust your position sizing. And obviously if you're going for 150 pip movement or 100 pip movement and you're risking 30 or 35 pips on that trade, it's still a 3-to-1 opportunity. And what you'll often find when you've gotten into the right trade, the markets don't often necessarily come back any further than they would in a normal market environment. So 20 to 25 pips is still happening, but it's not as frequent. When you've gotten into the position and the market is going to move, they might give 10, 15 pips of heat before they reverse and take off. So again, just adjust your stop loss to your position sizing to your stop loss, because again, if we work at the high and the low of the day, the high might be here and the low might be here. The whole premise is that once they've locked that in, if they've done a shift and they're coming back the other way, for them to go back up to that area to hit stops costs them money. This long tail or a engulfment, if there's an engulfment pattern there on the top, we'll make that a bull candle. If there's an engulfment pattern on the top and they take out that candle, that's the same thing as a pin bar. It's a reversal where they've cleared out the orders. They're not going to go back up there. There's nothing left for them to go and get. So when you have that concept in your mind and you place your stop loss up here, going to break even isn't necessarily the smartest thing to do in a lot of cases as soon as possible, because as you may have found out, and we've seen this almost every single day, they will come back and tap those break-even traders even after they've moved 30 and 40 and sometimes 50 pips away. So that brings us to our next point, making sure that you're taking some profits. So you may get into a trade, you may have a target that's 100 pips away, the market may be moving in 30 and 40 pip increments. If you go to break even, you still run the risk of getting stopped out. But if the market comes back up here, you're still not any greater risk than you were when you got into the trade. And that's one of the things you got to keep telling yourself. For you to get back in again later, it's again going to be, if you get stopped out and you chase the trade again, you're probably going to get a fill somewhere further down on the way to your profit target, and again your risk reward starts to get tighter in terms of, instead of 3 or 4 to 1, it might be a 2 to 1 or a 1.5 to 1. And that's why we talk about not trading inside the high and the low, because often there are some trades that will break out and continue or be trend trades, but when you take a trade inside, your risk reward increase, or your risk increases because your stop losses are further away, and the potential reversal against that position, if you were to lift your stop, is magnified. So again, never lift your stop. Your stop loss is your stop loss. If you have a trade entry and it's 1R and your profit target is 3R, and it's on its way to hitting that target, I know certain traders will once they're in the trade, will leave and walk away from the screen. Come back an hour later, if that trade has progressed but not hit their profit target, they may move it to break even at that point, but for the most part they let the trade run its course. There's nothing that they can do once that market moves. Once they're in the trade, they can stare at the screen all they want and try to read the price action. It has no bearing on the outcome of that trade. We talked about this yesterday. You can only control 2 things: how much you make and how much you lose. So it's really important, keep that loss exactly where it is. When you make the decision to go to break even, as I said before, in normal market conditions, usually 25 to 30 pips would be a normal quarter shift for me to take my stop loss to break even if I was filled at or near the numbers. If I'm filled a bit further away and I feel that they still have the volatility to stop me out, I will leave my stop in place until I get within a certain distance of the profit target. So Sometimes that's something you have to finesse on your own, because every market trade, every condition will have different volatility, and as a general rule of thumb, 25 to 35 pips of movement, especially in today's markets, probably 40 pips can happen very quickly. In strong movements, when they're going to go, they often don't come back. If you're caught inside of a high, if you're trading inside of a high back, these ones, they'll go 50 pips plus, but what they might do is pushes. And as they come back each time, those pushes will stop hunt traders who are getting in on the way down. If you're trading from the extremes at the high and the low, these are the ones that will often move right through to their target. Now, that said, when we get extreme volatility, sometimes the market will paint what's called an outside structure first. If the market has come straight down, very rarely will it go straight up. Sometimes it will paint an outside structure and come back. Now it has a measuring geometry space to break out of and move from. Something to consider if the market has gone up or come straight down and reversed, which brings us to our next point. Okay, so if you think about it in simple terms, if you have, you've traded London, or you've come home and you haven't had a chance to trade London or Asia, we've got a high in place, we've got a low in place, could be up near 50, and we have a low somewhere down near 50, but we're currently trading inside here somewhere. I will set an alert for the low and the high on the 6 pairs. We may be at highs or lows already on a couple of the pairs, but I will set an alert. Once the market works its way to one of these, if it trades inside, I usually don't want to pay attention too much to it. I'll revisit that once we're close to the equity open, but I'll generally set an alert. If the alert goes off, if the market has come down here to the low, the alert will go off. So that candle's still painting. It's a 15-minute candle. It hits the low. There's probably a few minutes left in the candle. I want to know, did that market come down in a we talked about the 1, 2, 3 bars to the high or the low in 3 bursts. That typically will be a stop hunt in the last leg of a move, 3 candles to the high or to the low. So the market may be trending inside, and then bang, 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 3 bars, 45 minutes. Takes out the low or the high. Once it's there, that's 15 minutes. The next candle, in order to confirm our reversal or some sort of price action back in the other direction, at a minimum is another 15 minutes. So that's 30 minutes, roughly, that you have to calmly assess the environment and the price action at that level, and at the timings, if indeed that meets your criteria for a trade back in the other direction. And then also what your profit target may be in terms of either trailing or taking money off the table. We talked about this yesterday, learning to take profits. Making decisions on the fly is not always the best thing to do, because you'll get emotional, you'll get hopeful, you'll get greedy, you'll get fearful, all these things. You might be up 70 pips and end up with 15. And you'll say, why didn't I take the 50? It might go 150 and you got 50, and you'll say, I should have got 100. All these things. If you're making decisions in live time, you make a decision, you live with it, and you learn from it, and you look at how you could have maybe done it better next time, or that you traded it perfectly, you're happy with that. And also your stops. We talked about cutting your losses. That's the most critical thing you can do. And that's why sometimes it's okay to just walk away from the screen once you have your stop in place and your profit target in place. If the trade behaves as it should, there's nothing that you can do by sitting at the screen trying to read the price action bar by bar. Let the trade play out. When you decide to move your stop loss to break even, there's nothing more to do. So the trade management part is a personal decision. Some people might want to trail a trade all the way up. It might go through 50 and they think it's going to 150. They may trail it up and a bar reverses and they cut the trade. Whatever that is, that's a personal decision. but these are the things that you definitely want to watch, but make sure you get paid. Focus on asymmetrical risk reward. And once you've taken, if you get 50 pips or you get 100 pips or you get a couple of trades of 50 pips, don't be obsessed with trying to trade every move. Take your 50 pips, call it a day, or your 100 pips, whatever it is, call it a day. Don't go back in and give money back to the market. Don't start chasing piker moves inside the ranges or anything else. If you have a great setup later, at the high or at the low, trade it again. If it matches your criteria and you really want to trade it at the next open or at the close, trade it again. So again, it's Friday night. We're headed into some great volatility again today. Today could potentially be another big day. I'm not holding anything over the weekend right now. Who knows what the weekend will bring with everything that's happening globally. We could open on a 500 pip gap. We've seen that before in the past. You don't want to be on the wrong side of that. Make sure you sleep well at night. Hopefully everybody's getting benefit, and your improvement in trading has, this week we've had just some tremendous opportunities to improve our skills and take money out of the markets. Quit letting the smart money take it from your bank account. So we'll go through some charts, through some chart examples again today. Again, I appreciate all the feedback, the questions. I'm trying to get through the emails and again, just trying to provide real live content each and every day of what happens live in the markets that I'm trading, like you, and all the stuff that we're faced with that the smart money throws at us. And just to rehash on something that I saw this morning on the rollovers. If you're holding on to positions on the rollovers, I saw the spreads widen up to 40 and 50 pips over the first hour between the New York Asia rollover at 5 p.m. New York time. So you might be up 50 pips, and by the time they gap it with the spreads and spike it, you're down to nothing. And even if you had a stop in place, they might have even gapped your stop. So if you've got money going into the close of the session, before the 5 p.m. New York Eastern Standard Time rollover, don't be afraid to take some profits. Stay disciplined, have a great weekend, and may the markets go with you.
Okay, traders, let's go through some examples again. Keeping things as simple as possible, working from the high of the day, regardless of the volatility or what the market throws at us, sticking to market equity opening times. Again, in Asia, pound Aussie made a new high, but you'll see that market obviously came to highs from the previous day, near numbers, traded back down into the 50 area, which again is in the middle of a 100 pip box, before pushing higher into the Europe Open, and 1 push, 2 push, 3 pushes down, forming a W pattern in towards the end of London, the opening of London. And then that market broke out and went up 100 and almost 150 pips, giving us a new high when it dropped back down. So now we redraw our highs. When the market broke out of that upper box, we would redraw the low. Obviously there's a breakout and a pullback level from the original breakout. Again, I'm just painting the picture of redrawing the highs and lows. Obviously this lower high is not really the high, it's inside of the box, but it did make a new low. And again, timings wise, this occurred at the US Open. They broke the low, gave a small bull pin, almost a inside bar back inside of the low, at which point the market moved up strongly in 3 pushes, 3 bursts, 1, 2, 3 bursts to the high, pinned the high at 50, came back inside of both of those highs and closed inside for a short sell into the close, all the way taking out the overall extreme low for the day. Just an example again of where the market continues to stop out traders on both sides. We've talked about the master template before of hitting the stops on the other side, and then trending. So hit the stops, trend. Then they hit the stops, they hit the stops, they hit the stops, they hit the stops, and then they trended. So we had the double stop hunt in the US session on the bottom and top for the trend move. And in the earlier session, we had a stop hunt, and a trend. But again, we work off the highs and the lows. The market went to round numbers, 50, cleared out the 50 pip box, pulled back inside of the double zeros, and moved through 2 100 pip boxes to take out the overall low of the day below 50. So again, today we saw into the rollover. That market did the same thing. This volatility, when there's a lot of uncertainty, the market will often just trade from extreme to extreme. And this is the trying to trade and jump in the middle is 50-50. You may find that even in a range like this, there's no certainty into which side they may break, but also your risk reward is a lot less than if you start letting the market expand out and trading from the extremes. So today again, we would draw our lines, our highs and lows, and we wait. Because at some point the market is going to either come up top to round numbers or go right through, or come down below to round numbers for a trade setup, or if it is going to trend, possibly break out and pull back for a continuation move. Let's take a look at the pound yen. Pound yen has been in a significant downtrend since last Friday when we originally discussed the trade from 37.50 area. That was on Friday, and that market again hit stops on both sides before closing near the original entry and then gapping on the open Monday. And that market has gone sideways and then moved down the last couple of days. We see some fairly large pins on last night's above the 3,300 level, but for today's sake, again, we draw our highs and our lows. This market has consolidated initially before breaking out strongly in the last couple of hours, going up and stop hunting the traders who shorted this last night into the close, which was 150 pip move down. They've gone up to get that trader, make sure he doesn't make any money before the weekend is over, or before the weekends. So now we've got traders who are short, obviously up here, and the market is deciding who it's going to go and stop out first. They may come back up and paint an M pattern up top, or they may come down below, stop hunt the trader who just traded long in Asia. But again, for now, for the purposes of today, if you're not in the market, we wait. We wait for either a new low or a new high to paint, or for one of those extremes to be taken out, and be able to identify an ideal setup for us to enter the market. If we look at the pound, same thing. Yesterday, a great example of a trend trade. So traders have the idea that you're constantly counter trend trading, and that's not true. We draw our highs and lows heading into the session. The market broke out before pulling back. So we have a redrawn low of the day in a trending market, but we don't know if it's a trend other than yesterday was a strong move down and then consolidated sideways. Once the market gave us this shift candle and redrew the high at the London near the last hour of the 12 candles, we have a 1-bar stop. Traders positioning themselves below the double zeros, and this is another example of where I would take a measured move as a minimum for a profit target of 2 times that range as a minimum. And that trade example is over 100 pips for traders who took this trade short. Obviously, in strong markets like this, they may want to draw a trend line down and wait for a micro trend line break as that trend steepens, or they can trail highs and lows all the way down. But again, trend markets or range-bound markets, it's all the same. We wait for them to show us what they're doing. They did a breakout. Even if you were long, for some reason you decided to position yourself long on the first low of the session, back inside of the previous day's low, which again you can see if you start watching, this isn't really a low. It's sideways structure. All that movement is sideways inside of 2 candles. there's not a pullback until they take out this high, at which point we can redraw that low. Then when they made our new low here, we redraw that, and they pulled back inside to give us a new high. Traders have an engulfment. Short position, 1 bar stop, measured move down as a minimum target. Pound Swiss. Yesterday, again, another example of a trending market. We redraw the high and the low. The market broke out, and so again, we redraw our highs and our lows. The market made lower highs, and again, no real trade entries. Even the 3-bar engulfment here didn't give traders, even if they traded that, once it went through the high, you'd have to move your stop loss to break even. This is the most vulnerable point for a market to reverse, is at the high or the low. We redraw our low again, and again, we still, as we're aware, are in a downward moving market. The market, 1 push, 2 push, doji, and engulfment candle. That's headed into the 7 o'clock stop hunt hour. If traders did not participate in that move down, the market then gave us a 1, 2, 3 to the high, pullback, and then an engulfment for the M pattern into the close. Again, this is at the US close. So if traders were going to take that, obviously they're probably in the North American time zone or the Europe time zone. But again, the US, the end of the 12 candles into the stop hunt hour gave traders an opportunity to short this for the move down. That's a trend example, but even up top, traders who were possibly positioned up near the numbers on shorter time frames were able to trail that all the way down. So again, no matter what the market throws at us, traders, we want to be redrawing our highs and lows every single day. Yesterday, again on the pound yen, a great example. They broke out in Asia. You want to notice again, there's geometry here. We had a rectangle form that they engulfed and shifted down 150 pips before going sideways and painting a W, and again giving us geometry. When you get geometry or a small rectangle at the end of a big move, that gives the market outside structure and an opportunity for a measured movement outside of that range. And again, you'll notice the 1, 2, 3 bursts, inside bar at numbers for the short, back with the original trend. The market comes down, retests the low of the day. So traders, this market moves, they think they've missed out. These traders think they've missed out on the move down. This market still gave 3 separate pushes of 100 pips all the way down before painting 2 pins and an engulfment candle in the US Open for 50 to 75 pips up. And again, 3 bursts into the US close and an engulfment pin stop hunt at the top into the close after the high, redrawn high of the day had been pinned and the market went sideways at numbers. So again, look at the numbers. Double zeros, 50, double zeros, 50. Market traded through 50 to the double zeros, broke through there to 50, pins, 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 reversal, pins, reversal. Stop hunt, pins, reversal. So let the market finish what it needs to do. Give us evidence that it's reversing or changing directions. If you don't have a candle formation that confirms your thesis, wait or look at a different pair. I don't recommend at this point going to shorter time frames just yet. But again, looking for pins, stop hunts at highs and lows, looking for round numbers, especially at the market opens, staying disciplined with your stops. Once they put the big structure through like that, you should basically have a normal stop loss afterwards. Same thing applies once they put pins in. If they've done a double pin on the equities open, afterwards your stops should be fairly reasonably normal. But again, if you have to adjust that to the candle size, change your position sizing. So hopefully this video helps traders. Trade from the extremes. Try to keep your stop losses tight and your profit targets a measured movement of your risk for 3, 4, 5, maybe more. And have a great trading day. May the markets go with you.
Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.